$26.99 a month. That's what premium costs right now. In 2013, when that plan launched, it cost $11.99. That's a 125% increase across 7 separate price hikes on the exact same idea, a website that streams TV shows. And every single time it happens, the internet says the same thing. Greed. Corporate greed. Shareholders squeezing the last dollar out of you before you notice. That's not the real story. The real story is boring. It's a balance sheet. And once you see the mechanism, you're going to look at your bill completely differently. So here's the actual question. Why does a company that's already profitable, already dominant, already sitting on 300 million plus subscribers need your money more this year than last year? Because for over a decade, Netflix wasn't paying for its content with your subscription. It was paying for it with debt. Think of it like a guy financing his entire lifestyle on a credit card, promising the bank he'll pay it back once he's rich and famous. That was Netflix from roughly 2011 to 2020. Borrow billions, make hit shows, grow subscribers, repeat. In 2020 alone, the company raised $1 billion in fresh debt specifically to fund content and acquisitions. That same year, Netflix's total debt peaked at $18.5 billion. And in its own words, in an actual shareholder letter, the company said it plainly. Our current plan is to continue to use debt to finance our investment needs. That means we are not making enough money to pay for what we make. We're borrowing it, which was fine until Wall Street stopped believing the story. Here's the part nobody's covering when they call this greed. In the first half of 2022, Netflix lost subscribers for the first time in a decade, just 1.2 million people. Sounds small? The stock dropped 76% in months. Investors weren't punishing Netflix for losing users. They were punishing it for proving the whole debt-fueled growth machine had a ceiling. So Netflix did something that gets almost no attention. It quietly rewrote its own business model. Before 2022, grow subscribers at any cost. Using debt, worry about profit later. After 2022, stop borrowing, get free cash flow positive, and fund content out of what you're already collecting. In 2019, Netflix's free cash flow was negative $3.14 billion. It was burning cash faster than a mid-budget war movie burns extras. By 2023, that number was positive $6.93 billion. That's not a rounding error. That's a company doing a complete 180 on how it survives. And here's the mechanism most people miss. If you stop borrowing money from banks and you still need billions a year for content, Netflix says it'll spend $20 billion on content in 2026 alone, up from $18 billion the year before. That money has to come from somewhere. It comes from you. You didn't become a subscriber. You became the lender. Every price hike is a bond payment Netflix no longer has to make to Wall Street because it's making it to you instead monthly on autopay with your thumbprint. That's the tell. Watch what happened next, because it escalates. In 2022, Netflix told shareholders something wild. Over 100 million households were watching for free, using someone else's login. That's not a rounding error either. That's basically an entire second Netflix, operating tax-free, rent-free, inside the real one. So the company launched what it politely called paid sharing, which is the polite way of saying, we found 100 million freeloaders, and we're done letting them ride for free. In the US alone, the first quarter of enforcement brought in 5.8 million new paying subscribers. One analyst at Third Bridge put it bluntly. Get a few bucks a month out of even a small percentage of freeloaders, and you've created, in his words, a huge recurring revenue base. Wells Fargo's Stephen Cahall went further, calling the crackdown arguably the bigger near-term earnings opportunity. Bigger than the ads business everyone was talking about. Charging people who were already using the product for free was worth more to Netflix than adding ads. So the debt gets paid down, the freeloaders get converted, prices go up on top of both. And what does Netflix do with all that new cash? Before we get into that, a quick pause, because this is usually where these videos slip in a sponsor, so let's do the same, minus the actual sponsor. And now back to the money. Netflix bought back $6.1 billion of its own stock in 2023 alone. Not reinvested into lowering your bill. Not held as a cushion in case content spend spikes. handed straight back to shareholders at the same time your standard plan was climbing from $15.49 to $17.99 to $19.99. Debt to equity fell from 1.97 in 2019 to 0.71 by 2023, which is the polite way of saying Netflix went from a company owned by its bondholders to a company owned by its shareholders, and shareholders don't want lower prices. They want margin. Operating margin, which was 20.6% in 2023, is guided to hit 31.5% this year. Price goes up, so margin goes up. Margin goes up, so buybacks go up. Buybacks go up, so the stock goes up. Nowhere in that loop is lower your subscription. Because here's the systemic part, the part that actually touches your wallet beyond just Netflix. This isn't a Netflix problem. This is the entire streaming industry's playbook now because it worked. Disney is running the same math. Every other streamer that spent the 2000s burning venture-style cash is now under the same Wall Street pressure to flip from growth to margin on the same timeline, funded the same way, by converting subscribers into the new debt market. You're not paying for better shows. You're refinancing a decade of Hollywood's credit card debt, $2.50 price hike at a time. That's the real mechanics behind why Netflix keep raising your price. It's not that they're greedy and never were fine before. It's that the entire company got rebuilt on purpose after 2022 so that people like you replace bondholders as the primary source of financing. And unlike a bond, your subscription doesn't mature. It never gets paid off. It just renews. I read the boring 10Ks and shareholder letters so you don't have to. That's the whole point of this channel. If that's useful to you, subscribe, because there's a lot more of this paper trail to go through. $11.99 in 2013, $26.99 now. That's not inflation. That's the sound of a company paying off its old debt with your card on file forever.